Markets are constantly evolving, and opportunities are always hidden behind the numbers. Welcome to Elite Talks, the exclusive monthly podcast by Fu Hung Securities. In this series, we analyze trends, share insights, and discuss trading strategies through the perspectives and experience of our experts, helping you optimize your portfolio across all market conditions. And this is our 5th podcast episode. I'm Mai Han, and I'm delighted to be with you today. In this first episode of 2026, we are once again joined by a familiar guest, Miss Nga, Head of Macro and Strategy Research at Fu Hung Securities. Hello, Miss Nga.
Hello, Mai Han, and hello to all investors. I'm very pleased to be part of today's discussion.
As we enter early 2026, the global economic and political landscape is facing a number of new sources of uncertainty. From your perspective, what are the most notable developments currently shaping market sentiment?
In my view, the most noticeable feature in early 2026 is the marked increase in unilateral actions by the United States, which has significantly elevated global uncertainty. The Trump administration's decision to launch an unprecedented operation to detain Venezuelan President Nicolas Maduro in early January 2026 has not only raised concerns about escalating tensions in Latin America, but also carries clear strategic implications for China, which currently imports around 500,000 barrels of oil per day from Venezuela. At the same time, the U.S. declaration of its readiness to take control of Greenland, one way or another, on national security grounds, despite strong opposition from Denmark and the international community, signals a tougher and more pragmatic security stance. Viewed in a broader context, this series of actions, from military deployment in Venezuela, geopolitical maneuvering over Greenland, tightening sanctions and economic pressure on Iran, to signs of interference with institutions traditionally seen as anchors of stability, such as the Federal Reserve, sends a consistent message that under Trump, Washington is willing to break with established norms and frameworks to maximize short-term strategic interests. As a result, geopolitical tensions are intensifying across multiple fronts simultaneously, forcing governments and investors alike to prepare for a higher risk environment in which political and policy shocks may have stronger and more unpredictable impacts on the global economic and financial landscape.
As you've just analyzed, amid the erosion of confidence in U.S. institutional independence, particularly regarding the Fed, do you believe the default advantage of USD-denominated assets is entering a structural decline, or is this merely a cyclical adjustment?
I believe that the default advantage of USD-denominated assets is indeed entering a structural decline, although this process will be gradual and does not imply that the US dollar will lose its central role in the near term. The U.S. administration's open pressure on the Fed's independence has weakened one of the most critical pillars of institutional trust, an element that has underpinned the dollar's reserve currency status for decades. As policy and institutional risks are repriced by markets, the USD no longer enjoys its former automatic privilege, but increasingly has to compete with stability, monetary discipline, and long-term credibility relative to other assets. This trend is evident in the proactive diversification of reserves by countries and investors, increased holdings of gold and other currencies, and the promotion of alternative payment mechanisms. In other words, this is not merely a cyclical adjustment, but a gradual structural shift in which the trust premium attached to U.S. financial assets is rising over time, weakening the U.S. dollar's relative position. While the U.S. dollar's central role cannot be fully replaced in the near future, over the long term, we believe that de-dollarization will proceed gradually. While the global outlook is facing significant uncertainty, Vietnam's economy closed 2025 with an impressive growth rate of over 8%. How do you assess Vietnam's economic achievements in 2025? As you mentioned, Vietnam's economy in 2025 ended the year with a relatively comprehensive and positive macroeconomic foundation. Despite some lingering weaknesses, the economy recorded a series of historic milestones, from trade, public investment disbursement, international tourist arrivals, to realized FDI inflows. These factors provided crucial support, enabling Vietnam to achieve growth of over 8% last year. The manufacturing sector continued to serve as the backbone, posting growth of 9.2%, comparable to the pre-pandemic period. PMI remained in expansion territory continuously from July onward, indicating that business confidence gradually moved past tariff-related uncertainties seen in the first half of the year. Trade activity also set a historical record, with total export turnover surpassing $930 billion and a trade surplus exceeding $20 billion, driven mainly by the FDI sector and high-tech exports. On investment front, public investment continued to act as seed capital, leading growth through the completion and commencement of numerous key infrastructure projects toward year-end, thereby creating expectations for positive spillover effects in 2026. In the services sector, international tourist arrivals exceeded 20 million, officially surpassing the 2019 record, indicating that Vietnam's tourism sector has not only recovered, but has entered a new growth phase. Altogether, these factors contributed positively to Vietnam's economy in 2025. Alongside these bright spots, what challenges do you believe the economy is still facing? Despite impressive achievements in growth and scale, Vietnam's economy continues to face structural risks, particularly related to the quality and balance of the recovery. The slow recovery in domestic consumption not only reflects rising living costs, but also indicates a cautious consumer mindset following a prolonged period of volatility. Households tend to prioritize savings and financial stability over increased spending, resulting in real retail sales growth remaining well below the pre-pandemic average. After price adjustments, Vietnam's retail sales growth in 2025 stood at 6.7% compared to 8 to 9% before the pandemic. From a trade and production perspective, a growing divergence in growth drivers is becoming more evident. The FDI sector continues to lead exports and industrial growth, while domestic enterprises still face constraints in financial capacity, technology, and policy adaptability. Increasingly stringent reciprocal tariffs and trade standards from major markets are adding pressure, limiting domestic firms' ability to integrate more deeply into global trade value chains. This poses a significant challenge to medium and long-term growth sustainability if the gap between the FDI sector and domestic enterprises continues to widen. Given both the achievements and the remaining challenges in 2025, how do you assess Vietnam's economic outlook for 2026? As we move into 2026, amid prolonged and intensifying global uncertainties, strengthening internal resilience will be a key determinant of sustainable growth. In this context, the state sector is expected to continue playing a leading role alongside the private sector as an important growth engine. The issuance of Resolution 68 and Resolution 78 is expected to lay the groundwork for a range of new policies to be implemented in the coming period. With a cautiously optimistic outlook, we believe these institutional reforms will not only expand the scale of the economy, but also orient growth toward a greener and more sustainable trajectory. On this basis, PHS forecasts GDP growth in 2026 to remain around 8.5%. Looking back at late 2025, Vietnam's stock market experienced some notable fluctuations. From your perspective, what were the most prominent highlights during this period? Overall, in late 2025, the VN Index demonstrated relatively good stability compared to many other markets, particularly amid heightened profit-taking pressure globally. In December 2025 specifically, on a relative performance basis, Vietnam's stock market outperformed most regional and global peers, ranking just behind South Korea, while many other markets faced correction pressures, especially in technology stocks. However, market liquidity remained at an average level, without any clear breakout, reflecting continued investor caution and a preference for observation rather than aggressive disbursement. In terms of capital flows, stocks related to the Vingroup ecosystem continue to play a leading role, while several industry leaders such as MWG and BVH began to attract renewed interest, indicating gradual capital rotation. Notably, capital flows showed clear divergence, with foreign investors returning to net buying of over $2.3 trillion on HOSE, while domestic retail investors were net sellers, and proprietary trading desks emerged as the main buying force, with net purchases exceeding $5 trillion during the month, helping to stabilize the market amid persistent external uncertainties.
Looking ahead, how do you assess the outlook for Vietnam's stock market? Does the VN index have room to improve its trend?
Entering early 2026, we believe Vietnam's stock market is benefiting from multiple supportive factors, both seasonal and policy-driven. First, the January effect is likely to reemerge, as over the past decade, most global equity markets have tended to perform positively in the first month of the year, reflecting capital reallocation and reinvestment in search of new opportunities. More importantly, the market is forming a new leadership anchor. In the first trading weeks of 2026, the influence of Vingroup-related stocks has shown signs of cooling, making room for leading state-owned enterprises to become the primary drivers of the index. This development is closely linked to policy expectations, particularly following the issuance of Resolution 79, which reaffirms the core role of the state economic sector and lays the foundation for a new growth cycle. Similar to Resolution 68 previously, we believe Resolution 79 could serve as a medium to long-term catalyst for key sectors such as banking, energy and power, oil and gas, infrastructure and construction, and telecommunications. Indeed, following the announcement of Resolution 79, state-owned enterprise stocks recorded strong gains, notably those within the PVN group, as well as major state-owned banks such as VCB and BID. In addition, the return of foreign net buying in December signals a clear improvement in capital flows, and if this trend continues, it will be an important support factor for the market in early 2026. Based on these factors, we believe the VN index has the potential to continue rising and move toward the psychological level of 1,900 points. However, maintaining this level sustainably may prove challenging as technical indicators are approaching overbought territory. In a positive scenario, the market is likely to enter a consolidation phase and build a new price base at higher levels, with 1,900 points serving as a key support for the medium-term trend. Strategically, we prioritize sectors including banking, oil and gas, utilities, consumer, and chemicals in the period ahead.
Thank you, Ms. Na, for your very insightful sharing. We hope your perspectives and assessments will help investors build appropriate strategies for the early part of the year.
Thank you, Maihan. Thank you to all our listeners. Wishing everyone a productive trading month and a successful 2026.
And thank you to our audience for joining Elite Talks. If you found today's discussion helpful, don't forget to subscribe to receive new monthly episodes from Fu Hung Securities. See you in the next episode.